All right, let's talk about something that honestly trips up so many Canadian investors: how our dividends are taxed. You look at your tax slip, you see these weird numbers, and you think, what is going on here? Well, if that's you, you're in the right place. We're going to clear all of that up today. Okay, so let's break this down. We're going to walk through the dividend gross up, the tax credit, and I'm going to show you why this system, which seems so complicated on the surface, can actually be a massive win for you as an investor. Here's how we're going to do it. First, we'll get the lay of the land with investment taxes in general. Then we'll dive right into the two big pieces of this puzzle, the gross up and the credit. We'll even run through a real-world example, see who gets the biggest benefit, and then I'll leave you with one important heads up. Sound good? Let's jump in. So to really get a handle on dividend taxes, you first got to see where they fit into the bigger picture. Because you see, the Canada Revenue Agency, well, they don't treat all the money you make from your investments the same way. Not at all.
Think of it like a spectrum. On one end, you've got interest income, from something like a GIC. That gets taxed the hardest. 100% of it is added to your income. Ouch. On the other, much nicer end, you've got capital gains. Sell a stock for a profit, you only get taxed on half of that profit. Much better, right? Well, Canadian dividends, they live in this special place right in the middle, with their own unique rulebook that, as we're about to see, can be incredibly beneficial.
Okay, let's get into the weeds and tackle the weirdest part of this whole thing, the dividend gross up. Now, I need you to stick with me here because on the surface, this is the part that feels completely unfair. It's totally counterintuitive, but I promise there's a method to the madness.
So what on earth is a gross up? It's basically the government telling you to pretend you received more dividend money than you actually did. And the reason they do this is, well, the company that paid you that dividend, let's say it's a big bank or an energy company, they already paid corporate taxes on their profits. The gross up is the government's way of rewinding the clock, trying to get that dividend's value back up to what it was before the company paid its taxes. So just how much do they gross it up? Well, for what we call eligible dividends, and these are the ones you typically get from big Canadian public companies, the current federal gross-up rate is a whopping 38%. Yep, you heard that right. You have to add 38% to the dividend you received when you report it. Well, let's make that real. Say you get a nice dividend check for $1,000. The first thing you have to do is multiply that by 1.38. And poof, for tax purposes, you didn't make $1,000, you made $1,380. Now, this is the exact moment where people get frustrated. They say, hang on a second, I only got $1,000 in my bank account. Why am I paying tax on almost $1,400? It feels totally wrong, I get it, but it's only half the story. Okay, so if the gross up is the confusing villain in our story, it's time to introduce the hero that swoops in to save the day, the dividend tax credit. This is the piece that makes it all make sense and actually work out in your favor. So the dividend tax credit, or DTC, is basically the government's way of saying, hey, we know that money was already taxed once at the company level. We don't want to double dip. So to make it fair, they give you this credit. And this isn't just a deduction that lowers your income. It's a credit. It's way more powerful. It slashes your final tax bill dollar for dollar. Right now, the federal credit for these eligible dividends is about 15%. But here is the most important part of this entire explainer. That 15%, it's not calculated on the $1,000 you actually got. No, it's calculated on that higher grossed up amount of $1,380. And that right there is the secret sauce. Okay, enough with the theory. The best way to understand this is to see it in action. Let's run through a full example from start to finish to see how this push and pull between the gross up and the credit actually shakes out in the real world for an investor. So let's meet John. This year, he got a total of $1,000 in Canadian dividends. Most of it, $800, came from big companies, so that's eligible. The other $200 came from a smaller Canadian company, so that's non-eligible. It just means it gets a slightly different calculation. And for this example, let's assume John's overall tax bracket is 30%. Step one, we gotta do that gross up. So we take his $800 in eligible dividends and multiply by 1.38. That becomes $1,104. Then we take his $200 in non-eligible dividends, which has a smaller gross up of 15%, and that becomes $230. Add them up, and for tax purposes, John's dividend income is $1,334. Now for the scary part, we take that grossed up income, the $1,334, and we multiply it by his 30% tax rate. His initial tax bill comes out to $400.20.
Now just look at that for a second. He received $1,000, but his tax bill is over $400 before the credit. That looks like a 40% tax rate. But don't panic, our hero hasn't shown up yet.
And here it is, the tax credit to the rescue. We calculate the credit based on those higher, grossed-up amounts we figured out earlier. We apply the proper credit rates to both the eligible and non-eligible portions, add them together, and John gets a total federal dividend tax credit of $186.58.
And here's the beautiful final step. We take that scary initial tax of $400.20 and we subtract, dollar for dollar, the $186.58 credit. And look what happens. John's final tax bill on that $1,000 of income is only $213.62. That's an effective tax rate of just over 21%, way, way better than his 30% marginal rate. See how that works?
Now, that's already a pretty sweet deal, right? But believe it or not, the magic of this system gets even more powerful. Let's see what happens when the investor is in a lower tax bracket. This is where it gets really interesting.
Okay, let's imagine the exact same scenario, but now John is in a lower 18% tax bracket. Now here's the key. His grossed up income is the same, and the dividend tax credit he gets is exactly the same. But his initial tax bill is now way lower, just $240.12. So when we subtract that same powerful credit of $186.58, his final tax bill absolutely plummets to just $53.54.
This chart really tells the whole story. Our higher income investor, who started at a 30% tax rate, ended up paying an effective rate of about 21.4% on those dividends. A great deal. But our lower income investor, he started at an 18% rate, and his effective tax rate on that dividend income dropped all the way down to just 5.4%. That is a massive, massive tax advantage. And this isn't just a fun little math problem. This is a real-world strategy. This is precisely why so many Canadian retirees, who are often in lower tax brackets, fill their non-registered accounts with high-quality Canadian dividend-paying stocks. They're using the system to generate an income stream that is incredibly tax-efficient.
Okay, before we wrap this up, I need to give you one really important heads up. It's so easy to look at an investment, see it pays a high yield, and just assume you're going to get this amazing tax treatment. But that is not always the case. You have to be careful with things like real estate investment trusts, or REITs. They often don't pay dividends, they pay distributions. And a distribution is a whole different beast. It can be a mix of things like regular income, capital gains, or even your own money being returned to you. Each part gets taxed differently, and you won't get that big dividend tax credit on the whole thing. For these more complex investments, you absolutely need to talk to an accountant. So there you have it. That confusing gross-up isn't there to punish you, it's just the setup for the hero of the story, the dividend tax credit. Together, they create a really powerful tax advantage for Canadian investors, especially for anyone in a lower tax bracket. So the question I'll leave you with is on the screen right now. Knowing what you know now, how might this change the way you think about investing in your non-registered accounts? Thanks so much for joining me.